How did Equity Bank achieve the 10.8 billion shilling that we saw in PBT? It's the first bank that is announcing the H1 results, so we don't really have a comparative analysis that we can do to the industry. But nonetheless, a 21% growth in PBT, how did you achieve that?
The profit of 10.8 billion was achieved as a result of growth of 24% on loan book. But that didn't give that commensurate interest because we had reduced our interest rates by 300 basis points. And so the only contribution was a growth of 8% on interest income. However, the initiatives that we have been pursuing for the last 4 years have started yielding significant results. We saw our merchant and transaction processing income grow by 58%. We saw our diaspora remittances and banking income grow by 23%. And those two contributed significantly. We also saw a significant reduction in cost because of the use of the agency network.
James, what would you attribute the jump that we saw to when it came to deposits, about 30 billion? And what is the trickle-down effect to your cost of funding as a bank?
We are now located in every village in the country. We have 13,000 agents out there making banking services very accessible, but not just accessible, but very affordable. I would say the convenience we have delivered to the people. 3 million customers are also using the mobile phone, and what we have seen is that they're keeping the money in the bank and paying when it is needed. So the withdrawals where money is kept at home because one can only afford to go to the bank once a month, that has added. Deposits have grown by 15%, and 15% of the deposit is another 30 billion. So when you look at the quantum, the cost of funds is still much higher, but the unit cost is what is affected, but the quantum cost is much higher because there is an additional 30 billion that has come in the bank, and we pay interest on our deposits.
During the investor briefing, when you're talking about value chain lending, you said something that was very interesting, whereby you say that if there's a breakdown somewhere in the ecosystem, defaults are expected. Now, let's talk about the tourism sector, which for some, they say it is at its brink because of insecurity. What's your comment to that respect?
It is true. If you look, the tourism sector is going through a very hard time because the market has collapsed sort of because of these advisories and also insecurity. But it's true that the pain is when one segment doesn't function, the whole value chain, because if the tourists don't come, the beds are not occupied, the employees are not required, the farmers' food supplies are not required. So as you can see, the whole value chain collapsed because of failure at one point.
And of course, another key sector of the economy, James, is agriculture, contributing 24% to the GDP. But I saw the numbers with regards to your loan book, and now you're only lending 3% to the agricultural sector. Why is that the case?
It is true, agriculture, while it contributes 24% of the economy, it's not a big consumer from the credit perspective. And it's because of the structure of our agricultural sector. It's more scale in nature and relies heavily on family labor. And it's for that reason that it's rarely borrowed. The second thing is the level at which our agriculture is. Agriculture is still primarily at low material production. It's a primary production, basically. And when it is primary production and it's more scale holder, then essentially its financial needs are very limited because they use the traditional methods. It's the jembe, it's the hoe, it's picking is just the sling basket that they require to pick tea. It's not mechanized. And agriculture will only be a big credit consumer when we mechanize it, because then you are introducing capital goods.
Before we even get to the outlook, give us an update on the rollout of the mobile virtue network operator.
I would say we are ready with the MVNO rollout, and we are really eager to give each of our customers a SIM card because that will transform the way we relate to them as a bank. Their experience will dramatically change, but we are patiently waiting because of the issues that competition raised.
Now we can talk about the second half, which is normally busier than the first. What is the outlook that you have for the second half?
The 24% build-up on loan book, it means that now that loan already exists. So we expect a higher interest earnings beyond the 8%. We also expect the cost-income ratio to decline a little bit, maybe to 47%. And essentially, a combination of those two would essentially deliver a better year. So we are confident we would sustain the momentum that we have had for the first half year.